Hey, welcome to The Explainer. If you're a homeowner in California, you know the drill. That property tax bill lands in your mailbox twice a year. But have you ever stopped to wonder, why? Why two payments? Why not just one? Well, today, we are going to crack the code on California's property tax system and finally make sense of it all.
I mean, that really is the big question, right? Why not just rip the Band-Aid off once a year? Or maybe break it up into 4 payments, like so many other taxes? Well, it turns out there's a really specific reason for California's method, and once you get it, honestly, your financial planning gets a whole lot easier. So, here's how we're going to break it all down today. First, we'll tackle the twice-a-year mystery. Then, we'll get into the one key concept that explains everything, the fiscal year. After that, we'll decode those deadlines, talk about why this actually matters to you, and wrap up with who you can turn to for help. All right. Let's jump right in. This whole twice-a-year payment thing, it's a huge point of confusion. And I'm not just talking about new homeowners. Even folks who've lived in California for decades can find it kind of puzzling. It just feels random, if you don't know the logic behind it.
And hey, if you've been scratching your head over this, trust me, you are in good company. Pretty much everyone finds this confusing. The fact is, most people have no idea why the system is set up this way. But here's the good news. Once the logic clicks, those dates suddenly become way easier to remember.
So what's the big secret? Is it all just designed to be confusing? Nope, not at all. It actually boils down to one single, super important concept, the county's fiscal year. Seriously, this is the one thing you need to know to unlock this whole puzzle.
Okay, check this out. This is the heart of the matter right here. We all run our lives on the regular calendar year, right? January 1st to December 31st. But the county government, the folks who collect your property taxes, they're on a completely different schedule. It's called a fiscal year, and it runs from July 1st all the way through June 30th of the next year. That one little difference, it explains everything. So let's just make sure we've got that definition down. A fiscal year is really just the one-year period that governments use for all their budgeting and financial stuff. And for every county in California, that year kicks off on July 1st. So get this. When you pay your property tax, you're not paying for the January to December year you're used to. You're actually funding this very specific July to June cycle. And here's why that fiscal year matters so much. Just try to think about it from the county's point of view for a second. They have bills to pay all year long, right? We're talking about schools, fixing roads, paying for firefighters and police. All that stuff needs a constant stream of money. If everyone paid their taxes just once a year, it would be a total cash flow nightmare for them. So, by splitting the payments in two, they make sure they've got a steady income to keep everything running smoothly.
Okay, so now we get it. The payments are split up to keep the county's lights on all year. That makes sense. But now, let's connect the dots. Let's see exactly how those payment deadlines we all know, and maybe dread a little, line up with this whole July to June fiscal year.
All right, this timeline really lays it all out perfectly. See how the fiscal year kicks off on July 1st? Now, look where your first payment falls. It's not due until November 1st, and that payment covers the first half of the fiscal year. Then, your second payment is due on February 1st, and, you guessed it, that covers the second half, carrying the county all the way through to the end of their year on June 30th. Let's dig into each of those payments just a little bit more.
So let's zoom in on that first payment. The really key thing to remember is this. When you pay that first installment on November 1st, what you're actually paying for is the period from July 1st through December 31st. You're funding the first 6 months of the county's year. And you definitely don't want to miss that December 10th deadline, because that's when the late fees start.
And then, same exact logic applies to the second payment. The bill that's due February 1st, that covers the rest of the fiscal year, all the way from January 1st to June 30th. This is the payment that keeps all those essential services going for the home stretch. And for this one, the absolute last day to pay is April 10th.
Okay, so we've covered the how and the why of the system. But so what? Let's talk about why this actually matters to you. Because understanding this stuff isn't just for fun facts. It has a real impact on your wallet.
Well, for starters, if you're a homeowner, just knowing what these payments cover helps you budget better and, more importantly, avoid those nasty late fees. But if you're in the middle of buying or selling a house, this knowledge is absolutely crucial. It's the key to understanding all those weird tax charges and credits that pop up on your closing statement.
And that brings us to a term you will 100% see on a closing statement, proration. I know, it sounds super technical and complicated, but it's not. It's really just a fancy word for splitting the bill. It's the process of making sure the seller and the buyer each pay their fair share of property taxes, based on the exact number of days they each owned the home during that fiscal year.
Here's the simplified version of how it works. Step 1. Your escrow officer figures out the total tax bill for that 6-month period. Step 2. They do the math to see how much the seller owes for the days they own the house. And Step 3. They figure out what the buyer owes for the rest of the days. That's it. It's really just about splitting the bill fairly so nobody pays for time they didn't own the property.
So, what happens if you're still a little fuzzy on the details, or you have a question about your specific property? Where do you go? Well, the great news is you've got a whole team of people whose job it is to help you figure this out.
If you're buying or selling, your escrow officer is the expert in all things proration. They handle the nitty-gritty calculations. Your real estate agent is perfect for explaining the big picture, how taxes fit into the whole deal. And for any official questions like, how much do I actually owe, you go straight to the source, the county assessor or tax collector's office. They have the final say.
And of course, just a quick heads up, what we've talked about today is for general educational purposes. Everyone's situation is a little different, and tax stuff can get complicated, so it's always a smart move to confirm the details with one of those pros we just listed.
And there you have it. The mystery of California's twice-a-year property taxes is officially solved. It's not random at all. It's all about funding the county's fiscal year from July to June. So I'll leave you with this question. Now that you know the why behind the deadlines, how are you going to plan for your next tax season?